All right, let's get into it. Today, we are taking a deep dive into a true classic, PepsiCo. But we're not just here to talk about soda and chips. We're going to break down what a detailed value investor analysis really says about the company. The goal here is to get to the bottom of the big question. Is this household name a smart place to invest your money for the long haul? Let's find out. And that really is the central question, isn't it? But, for any serious investor, the answer is never a simple yes or no. It really depends on your goals, the price you're willing to pay, and the kind of risk you're comfortable with. And that's exactly what this analysis helps us do. It gives us a really solid framework to work through all of that. And here's the thing that really frames this whole discussion. We have a very specific goal. The target isn't just to find a good company. Nope. It's to find one that can deliver an average return of at least 9% a year over the next 16 years. This specific number is our North Star, the benchmark we're going to measure everything against. Okay, so first things first, let's make sure we're all on the same page. When we talk about PepsiCo, what are we really talking about? Because it's a whole lot more than just a cola company.
I mean, PepsiCo is an absolute giant, a global conglomerate with brands you literally can't avoid: Lay's, Quaker, Gatorade, and of course, Pepsi. Their whole business model is built on high volume, selling stuff that people buy pretty much no matter what the economy is doing.
Now, what really separates PepsiCo from a competitor like Coca-Cola is this hybrid model. See, Coke is pretty much all drinks, but PepsiCo has its Frito-Lay snack division, and that thing is a profit-generating powerhouse, often with way better margins than the beverage side. This makes the whole business way more diverse and incredibly resilient. So we know what they sell. But in the cutthroat world of consumer goods, how do they defend their business? We're talking about their competitive moats. The advantages that keep competitors from eating their lunch.
So what is it? Where does PepsiCo's real power come from? What makes it so incredibly hard for some new company to come in and challenge them? Well, it really boils down to three core strengths that are almost impossible for anyone else to replicate.
It all comes down to three pillars. First, just sheer brand strength. These are names known all over the world. Second is their distribution dominance. They practically own the shelf space in every supermarket and convenience store. And third, their unbeatable scale, which gives them massive cost advantages. It's a seriously powerful combination. But of course, it's not all sunshine and rainbows. No company is without its risks. The analysis points to three big ones. First, and we're going to get more into this in a second, is a surprisingly high amount of debt. Second, there's the risk of margin compression from inflation. And third, you've got the constant shift in what consumers want, with more people leaning towards healthier options. Now let's see how those strengths and weaknesses actually play out on paper. It's time to get into the numbers. The good, the bad, and yeah, especially that debt. Okay, let's start with the good news, because it is a big deal. Cash is the lifeblood of any business, right? And PepsiCo's ability to just gush cash is a massive, massive strength. Just look at that number. Over $8.2 billion in free cash flow. So think of it this way. After they've paid for all the ingredients, the factories, the trucks, everything they need to run the business, this is the pile of pure cash profit they have left over. This cash is what fuels everything else. Okay, but now for the other side of the coin. Remember that risk we mentioned? This is where it really rears its head. While the cash flow is fantastic, the balance sheet itself is actually flagged as the single biggest worry for a potential investor. And here's the number that makes you go, a debt-to-equity ratio of over 250%. So what does that mean? Basically, for every $1 of its own money in the business, PepsiCo has borrowed $2.50. Now, that amazing cash flow helps them manage it, but that's a lot of leverage, and it's a big risk to keep an eye on. This chart tells a really interesting story about where the company's priorities are. A whopping 94% of all that free cash we just talked about gets paid out to shareholders as dividends. Now that's great if you're looking for income, but it leaves just 6% to be put back into the business. So you have to ask, where is the fuel for future growth going to come from? Okay, so all of this brings us to the main event for a value investor. Trying to figure out what the business is actually worth, totally separate from what the stock market says it's worth on any given day. To do that, you can't just pick one number. You got to look at a range of possibilities. In a more pessimistic or bear case, the fair value might be around $120. If you're super optimistic, in a bull case, maybe it's up at $165. But the most realistic base case puts the value right around $138. And here you see it laid out. That base case intrinsic value is calculated to be $138 per share. Now, compare that to the market price when this report was made, almost $151. The message here is pretty clear. At the time, the market was pricing the company well above its estimated fair value.
So, we've looked at the business model, the moat, the risks, the financials, and the valuation. Now it's time to put it all together. What's the bottom line? What's the final call?
Let's circle all the way back to that original goal, a 9% annual return. This table is super helpful because it tells you exactly what price you'd have to pay to get a specific return. And look, to hit that 9% target, the analysis says your buy price needs to be $135 a share. That's even less than the calculated fair value. And all of that leads to a very clear, simple verdict. Hold. It's not a sell because, hey, PepsiCo is a fantastic, durable business. But at over $150 a share, it's definitely not a buy for someone who wants that 9% return. The price was just too high to leave enough room for profit. So if you remember just 3 things from all this, make it these. 1, PepsiCo is a top-tier company, but the market knows it, which means it's usually pretty fairly priced. 2, that high debt level is the single biggest risk you need to watch. And 3, to get that target 9% return, this analysis says you need to buy in below $140. And there you have it, a full value investor's breakdown of PepsiCo. It just goes to show you, a great company doesn't automatically make a great investment if the price isn't right. So what companies should we put under the microscope next? We would love to hear your ideas, so drop them in the comments below. Thanks for watching.